Hello everyone and welcome back to another Pragmatic Investor podcast. My guest today is Alejandro Yela. He writes the Hermit newsletter on Substack. Our topic of discussion today was microcaps and small cap investing. As Alejandro points out in our conversation, there are some very good reasons why you should be investing in small and microcap stocks. And that is exactly what he focuses on his newsletter. In today's conversation, we talked about many different aspects about investing, such as why investing in microcaps can lead to much higher returns, what sort of things to look for when you invest in small caps, and we even went through exact examples of how Alejandro has used his investment process to achieve some pretty good returns in the past. I've been reading Alejandro's newsletter for the past few months and I've really enjoyed it, so that's why I asked him to come on today on the show to talk about his method. I think it's really interesting. You guys will get a lot of good value out of it. And if you haven't already, I highly recommend you subscribe to the Hermit on Substack. And if you haven't already, of course, please subscribe to the Pragmatic Investor wherever you're listening to this. Remember, I also have a newsletter on Substack. I cover macroeconomics, do technical analysis, and even do in-depth stock reports. I share my portfolio and everything. You can find it all on Substack. As always, I hope you enjoyed this conversation as much as I did. All right, everybody, welcome back to the Pragmatic Investor. Our guest today is Alejandro Yela. He is the Hermit on Substack. Alejandro, thank you so much for joining us today.
Thank you, James, for taking the time.
Awesome. Well, before we get into the nitty-gritty of investing, could you please share with everyone a little bit about your background, how you got into investing in stocks and, how you got into Substack?
Of course. Well, I started in bonds, actually. My first boss was a guy who was probably the guy with the worst specialization ever when it comes to finance. He was a specialist when it came to Argentinian bonds, and he was all about Latin American stuff. So yeah, I got initiated on that front. I did a little bit of stage in investment banking. I worked in a tech-focused firm, and I also spent some time over in Canada, working for a spin-off of Canadian Pacific. Canadian Pacific is a massive trading company, and they span off their consulting division. So I did essentially infrastructure. I did project finance, infrastructure consulting, but more on the modeling side of things. So I worked for World Bank in like a mega project that they wanted to fund a $10 billion project that would install electricity for 1 million people or something. And that summed to working for the family office sort of drove me over to the no bullshit side of things in finance, which is equities. And through essentially a process of discarding the stuff I thought was really bad, I ended up in the microcap space, which is essentially called microcap and now from 1 to about $300 million-ish in market cap, market size. Companies that are really small, still developing, but that may eventually become the next Apple or the next Nvidia.
Awesome, very interesting. Of course, very very robust background, and of course, originally like me from Spain. So obviously, great to have a fellow Spaniard on the show. Maybe next episode we'll do it in Spanish. If any of our Spanish listening audience is interested,
we can translate to Basque, and
I'm Catalan rather for me, and that's what I'm doing. Let's try and get a small audience as possible.
I mean, niche. Let's call it niche.
Niche. And speaking of niche, a very interesting niche, of course, that you're in. I find it really fascinating. Of course, like you said, you focus on micro caps and small caps. And of course, there are some advantages, of course, and some interesting reasons. So why, in your opinion, is this such an interesting niche to the micro caps?
Well, I've spoken a few times before with my audience over in Substack, and microcaps is just an output of my initial input, which is essentially a more convoluted way of saying I'm looking for margin of safety. So my premise is I'm looking for investments that can 10x or more in a decade or less. So eventually I understood that most of these opportunities exist in areas that are highly disregarded by the market, aka microcaps. Why microcaps? Well, microcaps have essentially a duality to them that allows people like us or retailers to have an edge versus the institutional players. The first one is illiquidity, and illiquidity leads to the institutionals can't deploy money effectively. So if they imagine you have like $1 billion and you want to put well, actually 10 million, 1% approximately of that to work. Well, you can't really do that with microcaps. There's 10 million out of, let's say, $100 million company. That's gonna lead to extreme pain when it comes to buying and extreme pain when it comes to selling. As you know, you push up the price while buying, and then you push down the price when selling. So these guys can't deploy effectively their money. Retailers, on the other hand, can obviously deploy money. If you have like 10K in savings, you can probably put it in a single company in the microcap space. And then there's the second part with this, which is information asymmetry, whereby people, since it's disregarded, won't really put the time into these companies. And at the same time, these companies are much more accessible. So I can, by talking to the CEO of the company, be able to gather a bunch of information that is mostly public, by the way. It's not public. It's, essentially a conclusion that people haven't really arrived to, but that you sort of put together with a mosaic of information. And that gives you a massive edge when it comes to investing. So you'll have a lot of conviction. You'll be able to build that up as you're sort of progressing through the information disclosed by the company, and you'll be able to deploy it when the prices of these assets are very, very low.
Absolutely. Look, like you said, that makes a lot of sense. Obviously, a much bigger opportunity in these undiscovered markets. Kind of, we could call it, I guess, asymmetry of information, right? Maybe not everything is so discussed. Of course, you get your mega caps. Everything is kind of priced in, right? And to an extent, if you're looking at your Teslas, your Googles. Now, I'm sure at this point, some people are already searching microcaps on their laptop. How? Because of course, we're all familiar with the big stocks trade on the Nasdaq or S&P. How do you go about finding microcaps in terms of where would you find these trading? Generally over the counter? Are you looking at stocks in America mostly or just internationally? Would you go about finding these stocks?
Well, it's a mixed bag. I'd say most of it has to do with being in different sectors for a long time and building a network. But there's obviously some instinct to it. So, for instance, I was fairly involved in the video game scene back when I was sort of putting out equity reports on several stocks when I was living in Japan. And I covered Hong Kong and Japan, and among other things, I was focused on the video game sector over there. And because I did that, I then, a couple years later, looked at the exact same sector in Poland and in the Nordic space. And I found a couple opportunities, but the fact that I had done the work already sort of translated into a much easier work the second time I did it. This is also analogous. For instance, I studied quark fairly extensively, like 2014, 2015. Quark is not a part of like spirit drinks, but it is a part of spirit drinks. So some of it, particularly of the distribution and logistics front, is sort of analogous, and you can translate from one to another. Most of these are qualitative, though, I must say, because the quantitative stuff, as you just said, is usually priced in. So if a company is making heaps of money, just quantitative, that's already in their financials. It won't be there. But then there's stuff like, I'll give you an example. DJ Co, the Daily Journal Corporation, which is Charlie Munger's former company, is a company that sets up legal software. Sets up a bunch of back-end tech stack when it comes to courts. And it does so in a period that's usually 5 to 7 years in length. However, in those first 5 to 7 years, the company doesn't report anything on the software. So it will just incur in cost, but it doesn't report it as future sales or current revenues. However, in year 7 or whenever this becomes operational, it instantaneously discloses this contract where they were supposed to, get 3, 4, 5 million bucks for a very long period of time. That is extremely sticky, meaning, even though it's a contract for the next 5 years, it might as well be a contract for the next 50 years. And that is a qualitative aspect of it. It is not yet reflected in the numbers, but it will be reflected in the numbers.
So yeah, very interesting. And in terms of logistically, right? Like, so would it be possible to trade most of the stocks that you're interested in? Is it possible to trade them just by, opening a regular brokerage account? Would generally be able to access any of these equities?
Yeah, most of them are. The only exception right now in my portfolio is the Argentinian section. I own 6 companies in Argentina, and it makes about almost 4% of my portfolio. And those you need to create essentially a local account. A similar thing happened when I invested in Turkey a few years ago. However, the rest are, you can essentially open up an interactive broker's account or whatever broker you're using and be able to purchase these, because even though they're small, they're usually part of, like the US and Canada and certain different countries in Europe, and they're fairly accessible. The problem usually comes when you want to buy them in quantity, though, because they're illiquid, you won't be able to purchase more than a few shares or a few thousand shares. On the lower end, the volume is about 20 to 30K USD per day. And that means that you can only buy $2,000 to $4,000. $1,000 per day without moving the price. If you buy more than that in a single day, you will essentially make it extremely expensive for you.
Right, of course. I guess there are some downsides, of course, to investing in microcaps or smaller companies. I'm quite interested. You say 6% of your portfolio is in Argentina. It's quite interesting. I was there a while ago. 4%?
Yeah, I think it's 3.78. But yeah.
It's interesting. I was actually there, was it last year, just as Milei got elected. So that was definitely interesting. And I didn't buy any Argentine equities. I did get some exposure to Argentina through an ETF, and that has done reasonably well. So I'm guessing your Argentine investments, some of them have probably done quite well.
Interesting. I had this bet with a friend, I think we bet in 2021, ended up 2021. My bet was that if Milei decided to become president, he would become the president, and we bet this stupid amount, but the odds were really good, and I won like $1,000 from him. So he eventually did win. I bought most of these in September, October, so right before he actually won. And they're agricultural related, so machinery, landowners, produce. There's a little bit of chemicals as well, but all related to agriculture. And the bet with that is related to salaries and capital deployment in Argentina, where Argentinian farmers are probably in top 1 or top 2% in the world of lowest paid people. And yet it's not because they're lazy or anything like that. It's because they don't have capital, they don't have machinery. It's essentially them putting hands and shovel maximum. So if these guys are able to deploy capital, that will just out of the 6, I think I break even in 4. I lost like 80% in 1, and then I'm 3x up in 1.
Yeah, it's interesting. Seems like a kind of no-brainer, right? If you can just get these tools out there, it should be pretty good at increasing their productivity, right?
Exactly. The point is, Argentina has a really bad framework, or has had historically really bad. I wouldn't call it a bad framework, actually. It's a poorly executed legal framework whereby certain laws, when it comes to protection of private property, essentially, were not enforced, and therefore they were arbitrarily enforced. A lot of corruption and all that good stuff. And because that's the case, or that's no longer the case, it allows investors to come in and be like, okay, we can deploy capital in this country. And that is especially true if they're able to dollarize the economy. That would be incredibly powerful. But yeah, once again, this is like a 10-year play. It's not a play for
It's very interesting. You mentioned you had that these were like agricultural companies. Now I'm curious. It seems like you're pretty indiscriminate in terms of what you invest in. Like are there any certain? I mean, maybe there's some sectors that you're more comfortable with, or are you just pretty happy to invest in anything that kind of looks interesting?
Well, and anything that's shaded is sort of the area where I operate. Most of these are though a sort of random events happening. It's not really that I look for stuff in retail or anything like that. There are some sectors that are particularly difficult, namely retail. Retail, I got involved with ASOS and the ASOS cleaning side of things, like the rehashing of their clothes. And that's an absolutely disastrous business. Like if you make a single mistake, you're toast, because your margins are like razor thin. So that's usually not a very good fertile ground. However, if you add an adjective to retail, like specialty retail, in this case, kids retail, like PLC, then it's completely different thing. Because specialists end up having a niche, and niches are usually connected with barriers of entry and pricing power. So yeah, there's what I usually look at is the derivative of a big sector. In the case of agriculture, for instance, I have machinery, distribution, and then like supermarkets. Then I have a little bit of manufacturing. I have chemical plant, and yeah, I think it was landowner or something related to cattle. I should. But anyway, these are fairly small bets for me. And once again, 10-year play. It is a little bit of a macro play more than a micro play. But the reason I executed them is because I know people. As I told you, my first boss, I have an excellent relationship with, is Argentinian. And as you can imagine, I sort of built relationships over there. And the second one, the math just is like super asymmetric. Like there's one way it can go, and it can either be a 2x or like 100x, but it's definitely, on the upside front,
it might 1,000x, but it'll be an Argentinian currency, and it'll only be a 10x really. That's still pretty good though.
If you look at my returns in Argentinian, Argentinian pesos, I'm up on all of them.
Well, it's interesting. You said it was kind of a macro play, and I kind of wanted to ask you a little bit about that, because obviously it seems like you focus quite a lot on fundamentals. I like to do a bit of macro. I'm just wondering to what extent you think about the macro as well, in terms of maybe what the Federal Reserve is doing, or, more recently, for example, we've seen big rally in Chinese stocks. Is that something that you were thinking about, or that you maybe even have some exposure to, China, for example?
Yeah, there's a lot to unpack there. So I'll start with Argentina, then Fed, and then China.
Fair enough. Take your time.
It's not really that there's a massive macro play thing where I'm, visionary and I'm sort of looking at all the levers and pulling them. It's just that the salaries don't make sense. The average farmer makes about an eighth of what a farmer in less than an eighth of what a farmer makes in the US, and that's the ones that are using capital. So the ones with machinery. If you look at the average guy, that is like the range is like $20 per month. It's crazy. It's a super low salary, and that's because they're essentially working on subsistence. So they're not selling produce, but they're barely selling any produce. They're essentially trading produce and harvesting their own things so that they can survive. And that turns like that just makes the opportunity extremely, extremely compelling. It's once again not a super macro play. It just so happened that it was there and I was looking and I was like, yeah, this is like right there. On the Fed side, I do look at rates, and these are particularly impactful when it comes to the calculation of WACC. So you actually have two components. You have the opportunity cost, which academics like to call the cost of equity, which is honestly a fictional thing it's the ether. But the opportunity cost is extremely real. But that being said, the other one, which is extremely tangible, is cost of debt. In terms of cost of debt, a lot of these companies are affected because they're moderately leveraged, but because of their status as a micro or nano cap company, they usually have worse conditions than Apple. Apple will have that debt that is costing them 3-4%. The average microcap will probably have about 3 to 4 plus SOFR. So it'll be 8 to 9% ish. And the difference between those two is absolutely massive if you pull it down and you make it less costly. Additionally, by combining those two numbers, the discount rates the discount rate itself, the valuation is going to be lower. And because it's lower, valuations are just going to go up. What's the famous phrase from Buffett that interest rates are like gravity stocks? Like it'll pull them.
Oh, right.
Anyway, it'll just make everything go up. And as China is particularly difficult. I think what they did is it's going to be really good on the short term and disaster in the long term. What they did is banks were essentially not being able to deploy capital. And so they boosted their ROE by leveraging everything up. And they allowed both individuals and smaller and local governments to get into debt if they want to buy either stocks or real estate. And that's an awful combination because instead of essentially discarding projects that were really bad and that were not feasible at 5%, what they did is they lowered the threshold. So these awful projects that were at 5%, that should totally be discarded so that new projects can come in at 10%. They are financing these deals, and these deals are garbage. They're like poorly constructed houses, and they're not so well structured stocks. And one of the main problems in China is VIE structures. VIE is their variable interest entities. These are the structures that you purchase when you purchase, let's say, Alibaba or Tencent sorts. And it doesn't give you the ownership rights to these stocks. It just gives you right to their profits. And because this is the case, and it will always be the case, you will not be the owner of anything in China unless you're Chinese. It has this additional discount. So if you're discounting things at 10%, you then have to add an additional 20% to that. Then instead of 10, 12%, because of or 50%, whatever your assumed perceived risk is. And because of that, the valuations of all these stocks will just go down unless the internal people are buying, which just will change the ratio even. I mean, it'll even push it towards an even greater share for the Chinese people versus the internationals, because internationals are not the ones receiving the loans to buy things. It's just the people.
Yeah, it's very interesting what you say. And I do find myself mostly agree with what you say about it being good in the short term, maybe not so good in the long term. I mean, we've had for the last couple of years now many kind of false starts to this China narrative where it's like, oh, they're going to start easing and people kind of get excited. And then it seems to have taken off a bit more. But like you say, smells a bit of, maybe stuff that was happening leading up to 2008. Of course, we saw what happened in the US when people were buying stocks on leverage right ahead of the the 1929 Great Depression. So it's definitely gonna be interesting.
I would add 2 additional depressions or crises to that. To me, it reminds me of the 90s crisis in Japan. It's very similar, especially when it comes to land prices and how those will develop. It also reminds me of the I think it's 1720, the South Sea bubble, where this one is less known, but essentially the monarch of Britain at the time of the British Empire, it got behind a company that was failing, and because the monarch sort of entered the scene, it just propped up the price of the company, and the company was putting out dividends that were like 200% of the profits. So it was inevitable that it would eventually clash and burn.
Mhm.
Yeah.
No, yeah, no, it's going to be interesting to see what happens, and that's why I'm always quite interested in macroeconomics. As much as fundamentals can push things, I think that macroeconomics definitely has a big thing to do. Like you say, China now is a little bit like Japan, in terms of they seem to kind of try to deflate this bubble, but it's obviously not quite working. We'll see how it pans out for the rest of the world. It's a
quick disclaimer there, though. I am not a macro specialist at all. So I've studied history, but I suck at playing macro. So yeah, don't listen to my interest rate swaps or anything like that.
All right. Well, let's get back to what we could call your area of expertise. You did mention before a company in particular. I think PLC. I think is the ticker you mentioned before. Now, I know we talked about this at one point. You mentioned you had a pretty good trade with this. Now, I'm not sure how much you want to disclose, but it'd be great if you could just kind of disclose maybe like kind of how you just kind of give us an example of how you found this company, what attracted you to it, and kind of and what played out with it.
Yeah. So PLCE is the ticker for the Children's Place. It's a specialty retailer in the US that recently transitioned from brick and mortar to online, and that only sells clothes for essentially children, infants, and preteens. So from the ages of 12 months to 12 years.
Yep.
These guys are, I'd say, leaders in their niche. There's Navy, Gap, and I guess Zara Kids is also in there. There's a bunch of companies that are competing with them, but it's usually not the case if you look at the online scene. The online scene, you've got the larger chains, stuff like Walmart and Amazon. They are as a company. However, the quality of it and the perception is not the lowest price point. So they're not in the same segment when it comes to Walmart and Amazon. They're still a little higher when it comes to pricing their stuff and at least the quality perceived. These guys are a company I should have looked at a couple of years ago, but that I rethought about in December 2023, where I heard this manager talking about it, a guy from Microcaps Club. I'm not part of it, but the guy is fairly present. His name is David Sandin. David Bastian. And, sort of piqued my interest. I read about it, didn't think about it because I looked at their financials and they were not very good. However, in May of this year, to be precise, I think it was May 24th, a group took over. And this is a Saudi non-royal, essentially private equity group that bought out 53% of the company. And these guys put out a letter May 24th that essentially described a Buffett-esque approach to restructuring. Maybe not restructuring, but sort of leaning out a company as if it should have been done. Why is this the case? Because even though the company transitioned, it went from about 10-20% online during COVID, late 2019, to about 70% online as of December 2023, first quarter 2024. Even though that happened, their SG&A, their personnel costs and distribution costs were exactly the same. That shouldn't be the case, because if you transition to an online, you should be able to, well, let's be crude, but lay off a bunch of people and sort of centralize your distribution hubs so that unless something really wrong happens, everything will be centralized and your cost per units will just increase. So you're going to have a much lower fixed cost, and then your ability to deploy like volumes without additional costs is just extremely benefited from this change. And they sort of laid out this plan, sort of what I described in their letter. And what happened is recently they started executing on it. So in their Q2 results, it's a little bit modified because they report their earnings with about a month's delay. So technically it would be July instead of June. But their Q2 results were really good. Not only were they good, but they were also extremely aligned with how they sort of envisioned this is gonna play out in the coming years. And so how I deployed money in this was I reread the letter. I already had the work done because I had done it over the last 6 months. Just had to rehash a bunch of things. And I started deploying capital in mid-June. So I just went from, I think it went from 2% in June approximately, all the way up to 8% right before it popped up. And then in a matter of 24 hours, it increased by 84%. And I think I'm up 150% right now. So it technically is the largest position. And definitely my best play ever. I don't think I've ever experienced such a volatile, especially for the upside play, where I think my lowest price point was about 480, and my average is right under $7, like 680 or 690. And I think it's trading 15, 16. Yeah, I'm not sure. I've been checking.
Awesome. Well, congratulations on the good trade, and you're still long on the stock. Then you haven't taken any profits.
No. I haven't sold. The way I invest, which is sort of the way I think most people should invest, like a Berry or something. Unless you're like a genius, you can play the markets ups and downs. You should put your money and just sit on your hands, being able to pick any further. So yeah, this is again a 10-year play. It might not be a 10-year play because of how this is structured. When the catalyst is gone, which is the restructuring of the company, it'll be cash flow positive. And this is not a company that's growing, barely growing. It'll grow at like 5% or something. It'll grow with the sector and with inflation. But it is extremely profitable, and it should be extremely profitable. And the reason it's not making money right now, it's because of poor management, which is essentially being kicked out of the company. With the new management coming in and restating those profits that should have permanently been in there. It's also a small company, by the way, but it's a company with a market cap of about 100 or 200 million now. The lowest was probably 50 or something like that. But it's a company selling like $1 billion worth, $1 billion plus bucks worth of clothes. Like it's a pretty big operation.
Well, yeah, it's pretty good. And I guess when it comes to microcaps, there must be a lot of opportunities that come around. Like you say, maybe like you measure qualitative assessment, not like, a fund comes in that wants to take over, or maybe even stuff like acquisitions, right? So kind of event driven to an extent, I guess.
Well, there's catalyst. I wouldn't call it event driven. There's definitely catalyst that where you are essentially activating money in these places. The easiest catalyst to sort of point out are usually essentially splits within the business. So you split out, or you spin off, or you essentially divide the business into 2 sections, and you sell out the section that isn't performing and keep on going with the one that's performing. That's usually the easiest way of unlocking value. There's a bajillion other ways. Like you'll have equity repurchase, you'll have debt repurchase, especially at these prices. You'll have some M&A. Well, M&A, I wouldn't call it. The issue with M&A is most people suck at it. So usually inorganic growth is not a good thing. But if you have specialists at the helm of this, then it can work out really well. There's many of these that when you sort of put them all together, they lead to a better outcome. In the case of PLC, it's very straightforward. They have about 5,000 employees. Once about 1,000 of those are gone, this company will be They're- and there's a little bit of distribution as well, but they've already sort of arranged that.
Yeah, it's very interesting. And I know another element you mentioned before, you mentioned how, with smaller caps, maybe it's easier to like get information on management. It's interesting. That is something that I think maybe oftentimes is overlooked a lot, kind of the human element, right? How much of an impact it could have to just like, change management or change CEO. Have you ever had an instance where maybe like you got in touch with a company or like where you saw a change in the management and you'd like, you just talked to someone and went, oh, well, maybe this is the right person, or maybe I should invest in this company because of that?
And that happens, but it happens rarely. Like, I think it's once in my life. I wouldn't expect it to happen more throughout my life. Extraordinary people are very, very rare, but the opposite has happened many times, where you're sort of thinking, oh, this company is pretty good, and then you meet management and you're like,
It's big.
happen. The thing is, if you look at the numbers, you'll be able to observe the past. People think that that's sort of an indication of what's going to happen, but what really is an indication of what's going to happen is both the plan that these guys have laid out and their ability to execute on the plan. So without knowing them, without understanding what they want to do and how they want to do it, and whether they're capable of doing it, you can't make a move on a company like this. The latest case of management drama, I'll call it, is actually, or used to be, my largest position, which is Carlytics. And Carlytics recently changed their CEO. The previous CEO I had fairly regular contact with, mostly written and sometimes on a secondary note. So I'm fairly acquainted with another investor that had regular contact with him. But the new CEO, who was the former COO of the company, I've never spoken to. He's been in the company for about 2 years, and yet I haven't been able to talk to him. I know about him because of the people around him, but I haven't been able to talk to him. It's not a no-go for me, but it definitely is something we need to fix. So in hopefully the next few months, I'll be able to talk to him, even though I have a pretty good idea of where he is. The CFO of the company reads my Substack, and every time I release something about Pragmatic, she's asks me very politely to send it over to her. So I do have regular contact with some people within the company, but sometimes the upper echelons are quite inaccessible, especially when there's rotations or fast changes or an interim CEO. Stuff like that.
No, absolutely. Yeah, and it is great to be able to invest in a company where you have that kind of point of touch, and you can actually talk to people, or almost even be like Warren Buffett, right? Like an activist investor. Maybe you can call them up and say, "This 10-year plan doesn't make much sense."
I wish, but I've actually released a few interviews with CEOs, and there's one incoming as soon as Q3 is released. And I talked with Massimo Gismondi. I talked to Dr. Frank Massimo Gismondi from Gismondi and Dr. Frank from Limes. Now from Aikiver, I'm going to talk with the CEO and maybe someone else. I can't disclose at the moment. But that sort of is part of the edge, and it's also, it is an edge for the Substack, the newsletter itself, because a lot of this information is out there, but people will either not take the time or they won't have the ease of access. If you're living in the States and you want to talk to someone in Spain, it's going to be pretty hard just because of the distance. Doesn't mean that you can't make it happen. But I'm just easing that process and then releasing this information, making it super accessible in like 1 year audio format, which is awesome. I wish I had that sort of resource.
No, absolutely. There's a ton of value in what you do, and of course, I thoroughly encourage anyone listening to check it out. Just one last question before we leave off. I was also wondering, obviously, you like microcaps, and the natural extension of that would be, well, why not even go further, right? Why not do like pre-IPO or startups? Is that anything that tempts you at all? Something that you play with?
They might seem similar, but they're not. Like Gismondi, for instance, is a 7th generation business. Like, it's been around for a really long time. And because you have that sort of track record, then you have the heritage. You will sort of know where these things are happening. Most of these companies are actually listed and they've been listed for some time, but they're usually silently listed. So IPO and pre-IPO isn't really a problem for me. The issue is most IPOs, especially the ones you hear about, they're like really high. So you'll get a very bad deal coming in after the first round, essentially, or the first and second round sometimes. So it's just that the price point is not very good. Like the reason I won't there is because won't go there. The price isn't very good. Yeah. As to venture capital, that's a completely different beast.
Right.
Right. My personality is not suited for that sort of stuff. Like I can bear a 90% decline on my stuff, but only because I understand it fairly well. But I would probably not sleep if I entered the world of venture capital, which is, not among my priorities. To like my sleep.
Yeah, that's definitely a priority number one when it comes to investing. Is at least keeping a good night's sleep, because otherwise what's the point, right? You're gonna be losing sleep.
That's the ultimate goal.
Sleep's very important, especially as you get older. I've found out. So, like I said, absolutely invaluable information. Really love what you're doing. Obviously, the links will be on the description. But before we log off, let everyone know what you're doing on Substack, and also maybe if they can find you anywhere else.
Yeah, of course. I mainly use Substack because I sort of concentrated everyone that I know over there. I won't plug in any other account but that. In Substack, I write the Hermit. The Hermit is a fairly simple newsletter that I release every Tuesday, and where I'll give you essentially one of three things. I'll either update you about my portfolio, and it's not like I bought something and sold something. It's more like a 15 to 20-minute write-up about my entire thought process behind certain things and certain events within the portfolio. I'll do in-depth and not so in-depth write-ups, which range from, say, 7 minutes all the way to like an hour at the max, where I essentially go really deep into a company, not only their financials, but the business. And I try to make this a timeless piece where it doesn't really matter, if you read it now or you read it in 10 years, it will still describe the business as it is in its core. And then the third part is more of the educational side, where I'll give you my random thoughts on, like I mentioned, the 70-20s bubble, or like the Japanese crisis, or I think that my latest post was titled "Natural Monopolies." So I'm essentially ranting on the fact that natural monopolies are nothing but government licenses being handed out to a bunch of people that can't compete without them. So yeah, you'll get my thoughts on stuff related to investment and hopefully in the process, with these three things, it'll make you a better investor and a more complete person, I guess. I definitely really enjoy writing it, so I hope you enjoy it and read it.
Absolutely, it really covers through in your writing that you enjoy it. You can tell I've really been enjoying reading it myself. Obviously, highly recommend everyone to check it out. The Hermit on Substack, and Alejandro, it was great talking to you. Thank you for taking the time, and I hope we can do this again sometime.
Yeah, for sure.
Awesome. Well, thanks for joining us, everyone.
Well,